right? And we're going to send this recording out to everyone who was not able to join, but that includes you all as well who did join. All right. So for those of you who didn't join us last week, my name is Dominic Green. I'm the program manager for the Keys to Equity program, and I'm going to pass it over to Charles.
Yes, and I'm Charles Ampate, the housing counselor for the Keys to Equity ADU program.
Thank you, Charles. So you'll get the chance to hear from both of us today. So a few folks coming in, there we go. Like I said, you'll get the chance to hear from both myself and Charles today. So we'll go ahead and get started. I'll kick it off, right? So last week, we covered the program overview, all right, where we talked about what is the Keys to Equity program and why it was, why this program was brought to us to manage through the city of Oakland, right? Okay. This is just a quick disclaimer. The information provided in this webinar is supplementary, right? It doesn't pertain to anyone's actual situation, okay? So these are all just examples, all right? Before we dive into this slide, I will say if you have questions, which I'm sure folks will, you can place them into the chat, but since today myself and Charles will be facilitating, I would highly recommend you all just come off mute and raise your hand, or just come off mute and ask your question, or put it in the chat box and we can address it after we finish facilitating. But we'll try to check it as much as possible, but that might get difficult once we start to go through the slides, okay? So I recommend just coming off mute or making sure you get to ask your question in the Q&A after, all right? Cool, so on this slide, this is the overview of the entire education series. So last week we did, again, the overview. Today we're gonna go through financing your ADU, which is a really, really big part, right? It's the main focus of the program. Next week at the same time, we're going to talk about working with the general contractor and architect. We would highly recommend you all attend that as well. And then the following week after that, we'll do modules 4 and 5 actually together, managing tenants and landlord legalities. Another session we highly recommend you all attend. And then after this, we'll wrap it up. After that, we'll wrap it up with a closeout session where you all can come in and ask questions, okay? I have another reminder for you all. Tomorrow, we have office hours. So you should have already received that link. If not, you will receive it again tomorrow at 10 a.m. But that will be at noon. Okay, I believe the link will be sent out at 10 a.m. for those of you who need a reminder and need to register, need to get the link for it. But that'll be at noon. Okay, so office hours, right? That's an opportunity for you all to just to come in and ask any questions you have about the program, right? I would highly recommend you all come to that as well. If you don't get your questions answered here, or you think of something later tonight after this presentation, come in and ask those questions and you'll get those answered. Okay, cool. So we're about to dive into financing your ADU. Okay, so in terms of financing your ADU, these are the categories we'll go through today, right? We'll talk about, again, what is an ADU? What are the financing factors? What should you know about ADU financing? What are the different construction loan types you have available to you, not just in the program, but in general on the open market? And then we'll talk about project cost, right? And then we'll dive into Keys to Equity financing specifically. Okay, and that's where Charles will get to run through some scenarios with you all. Okay. All right, so we talked about this a little bit last week, right, in the overview, but what is an ADU? In general, an ADU is a secondary home, right, or micro cottage or tiny home. That's usually around 400 to 1,000 square feet, usually not bigger than that, right? That shares the same lot as your primary residence. Okay, this can be a garage conversion on your primary residence. It could be a detached, separate tiny home, in your backyard, or it could even be an addition to your primary residence on the second story, right? So there are a few different ways to do this. Some folks even have tiny homes on wheels, which is not something we currently offer in the program. But if that's something you have an interest in, you should follow up with the still, because we have that resource for you. Okay. So what are the financing factors? As a homeowner, what do you have to consider? What's going to be considered, right? And from the bank or from the lenders that you go to when they're trying to decide how much money to give you, right? So they're going to view your property. They're going to ask about the dimensions of the property. They're going to ask about your timeline of living in the property, right? That's going to show them, that's a part of what shows them how much debt you're able to take on, right? The length of time you lived in the property and really the, maybe the amount of late payments you've had, things of that sort, right? So your status with your mortgage payment, okay? Your credit score Any lender for anything is going to look at your credit score because they consider this, expressing your lending worthiness, right? Your credit score. It doesn't tell all stories though. That's just the truth, right? And that's why we work so hard to build 2 portfolio products. So they're not really so focused on your credit score, right? And we'll talk about credit when we start to talk about more about the self-help products that we offer. Okay. Of course, they're going to look at your income, right? And your existing debts, right? To calculate your debt to income ratio. That's going to let them know out of all the income you bring in each month, how much are you spending on bills each month, right? That's going to tell them, okay, they have room to take on this much more debt in construction costs, right? And then nowadays, the last bullet point, which is honestly newer, lenders are going to account for the value that your ADU might add to the property value, right? If they believe, this it's going to get built and not going to add much value, they may be less likely to lend you the money to build it, right? The way they're going to assess this is by looking at current ADUs on the market, right? And comparing your ADU to other ADUs of the same square footage or comparable square footage, right? The reason I said this is a new thing is because ADU development is very new in this space. So there aren't that many ADUs to compare your building of an ADU to. So not all lenders will use this, but those that have access to it will, right? And it always helps you all out as a homeowner, having other ADU examples for them to compare yours to, okay? So that's why we got to get you all to build some more ADUs to make this easier for everyone. Okay. What should you consider when financing an ADU? Okay, these are some things that should run through your mind before you go into financing for your ADU. You need to work with the general contractor, right, to confirm you can build on your property. And this is going to come in the form of a site assessment, okay? You need to assess feasibility, cost, increased value, and potential income, right? That's something we can help you do, as well as the lender. You need to compare interest rates and closing costs, right? All of these products on the market are going to have different interest rates and fees associated with them. So you should make sure you're comfortable and you're aware of what those are before signing any documentation, right? And also you should secure a reliable construction team. Why? Your construction team should be in direct communication, not only with just yourself, but with your lender, right? There's this thing called a draw schedule, which is the dates in which the lender is going to pull money from your loan to give to your contractor to complete work on the schedule, right? So you need a reliable construction team for signing off documents for financing. A lot of times the lenders won't even close the loan all the way until they know you have this in place. All right, and that's what we're here to help you with. So don't think too hard about it, right? This is all a part of our program. Okay. Now what I'm going to do is go through each one individually. These are the types of loans you can leverage to build an ADU, but not just to build an ADU, just the types of loans that are typically used for construction, okay? They can be used for other things, but we're going to talk about them in the sense that they're being used for construction. All right, we have your cash out refinance, your HELOC, which is a home equity line of credit, works like a credit card almost. Your home equity loan, very similar to a HELOC, but not the same. We'll talk about the difference in a second. You have your 203K loan, right? And you have your savings, your cash, and private funds. And then you have the KeySec Equity Program financing. And that's separate from all of these other ones because we created those within the program, and they're only offered in the program, okay, through self-help. All right, so now we're going to talk about each one individually. Again, if you have questions, you can use the raise your hand button on Zoom or just come off mute, and I'll stop to answer your question. All right, cash out refinance. So this is actually the first product, self-help and RNHS, Richmond Neighborhood Housing Service, which is our team, we offered that we created for the program. All right, this is when you would take your current home mortgage and refinance it completely. Right, so right now you have a mortgage, that's your first lien. If you refinanced it, you refinance to another type of first lien, typically going up in interest. Right now, I say that to say it depends on the market. Right, this may or may not be worth it to you. For many of you who have a very low interest rate right now, well, it might be difficult for you to want to refinance into a higher interest rate, right? But on that same note, if you're going to rent out your ADU, right, it may still be worth going up in interest to get your ADU built, right? Otherwise, you would have to go and find other means to get that money to build the ADU, right? But a lot of times, renting out your ADU will offset that increase in interest, right? You'll see that with numbers a lot of times too, okay? Home equity line of credit. So this is not a home equity loan, This is a home equity line of credit, right? This is not like a first lien refinance, right? It's completely different. This is the second lien product. So it's not refinancing your first mortgage that you have. It's adding on an additional layer of debt, right, with its own interest rate that you would pay at the same time as your current mortgage. Okay. Now, the good thing with the home equity line of credit is you only pay on what you use, right? Unlike a home equity loan. A home equity line of credit, you only pay on what you use. So it's like a credit card. If you get a home equity line of credit for 20,000 and you use 5,000 up, where you're going to pay on 5,000, not the whole 20. Okay. And it's home equity line of credit, right? Meaning they're going to pull from your home's equity to give you this line of credit, right? So you're going to be, when you pay it back, you're paying yourself back with interest, really, right? And it goes back into your equity. Let's say your home is worth 200,000 and, the lender's wanting to give you a HELOC loan up to 90%. Or let's say it's 100,000, keep it simple, right? If they're going to give you 90%, then you get 90,000 of that 100,000, right? Or 180,000 of the 200,000. But that's as much as you can get in a line of credit, and you only pay on how much that you use out of that amount. Okay, cool. Now, home equity loan, similar to a home equity line of credit, but it's not the same. It's similar in the sense that you're using your home's equity, right, to fund this loan or the line of credit. But the loan, you actually get a lump sum of money. So it's not like the HELOC where you only pay on what you use, right? You start to pay on this loan right when it gets dispersed, right? Based on whatever payback schedule you set up with the lender. Okay. So depending on what situation you're in, you may prefer the loan or you may prefer the line of credit. But the difference is with the HELOC, the previous slide, it's like a credit card, you pay on what you use. Home equity loan, if they lend you a home equity loan of 100,000, well, once the first payday comes, you'll have to pay on that 100,000, not even if you only use 10,000 of it, right, for the loan. Okay. And this home equity loan is actually what is the second product that Self-Help helped us create. So right now we offer a refinance product and a home equity loan. Okay. Now, if you hear about these products and they still don't really interest you, you prefer the line of credit, the home equity line of credit, we have lenders that can give you that as well, right? But it really comes down to your financial situation. That's what Charles will work with you around to understand which is best. Okay. So we don't offer an FHA 203K loan, but we included it in this presentation because you should know what it is, because it is something that a lot of folks will use to build their ADU, right? An FHA 203K loan is a loan that allows you to purchase a primary residence as well as renovate or build on it at the same time with that same money, right? So let's say they give you 500,000. That 500,000 is expected to be used for the purchase of the property as well as any renovations to the property, right? In one loan amount, one interest rate, which is really, really cool. Okay, so let's say you want to buy a home for 400,000 and you want to build an ADU on the back of that, right? And they're going to give you a loan, an FHA 203K loan for 700,000. Okay, so that means you can take 400,000 of that 700, buy the home, and then the rest of it you can use to build the ADU. Okay, and you'll pay back that entire loan on one payback schedule. I see a question in the chat. Let's see. Can you get a 203K loan just to build? Yeah, you can, right? You can definitely do that. It's just you have to let the lender know that's what you're going to be using it for, right? And that's definitely something you can put in your application. But yes, you can. Absolutely. Okay. All right. And another way you can fund the construction of your ADU, obviously, is your own savings. A lot of people do that, right? It may be harder in Oakland, to be honest, right? It's a little more costly, which is why this program exists. But yeah, you can obviously use your savings to fund anything you'd like, for sure, the construction of an ADU. Okay. So now what I'm going to do is pass the floor to my colleague Charles, and he's going to go through the actual Self-Help Federal Credit Union's mortgage products that are offered to you all through this program. Okay, take it away, Charles.
Okay, thank you, Dominic. So Self-Help is the program lenders for the Keys to Equity ADU program, and no participant is limited to only Self-Help. You can deal with any lender or with private funds to build in your own ADU. So for the product that Self-Help has is one, a cash out refi, and we've developed a second product, which is a home equity loan. Yeah, but the guidelines are different, you know, comparing it with what we have on the market. So all loans will go through underwriting, you know, to include the funds for your construction, and it can the loan term can go from 10 to 30 years, you know. Yeah, so it's either a cash out refi or a home equity loan. And prior to we having the second lien, and due to the economic situations, there are some changes that has come for the first lien, which is the cash out refi. So now the origination fee is now 1.5%, not to exceed $10,000, and then the debt to income limit has been raised from 43 to 48%, and there is an ability to buy down 1% up to 4 basis points, you know, of the rates. And then you can close the loan to homes held in living trust. So now we are working with homes held in living trust. Yeah. So what they're going to do is they just take the living trust off, and after they've given out the loan, you lock it back into the trust. Yes. And then there's a rental gap assistance. So as construction is going on, most of the time it is suspected that when loans have failed, there is a grace period of 30 to 45 days. So after that period, if construction would take that much, like 8 months, all they have a rental gap assistance to, you know, fill in for those months. And then they are going to use 75% of rental income, future rental income, as income to in calculating your debt to income, you know. Yeah, can we go to the next slide? So in the next slide, so how much does somebody need for an ADU? So it varies depending on your location, and then the finishes, and then even the size of ADU you want to build. So the cost, it does include the design, the construction, and all other utility hookups, fixtures, finishes such as countertops and flooring. It excludes any type of furnishing. So it's just for the build, you know, and furnishing is up to the individual, you know, whatever couch you want to put in there, TVs and all those other things are up to the homeowners. So your general contractor will conduct a site assessment, which is a feasibility study, you know, to identify what your lot is, the ADU that can fit, the style, and all the designs that might be able to might suit your lot. Though we do have 3 designs from our catalog, which one can choose from, but nobody is tied to our designs. You can also work with the GC and architect to design your own plan as well. So what is pre-development cost? So pre-development cost is the cost which is associated with all other activities, you know, which must happen before construction or rehab or renovation of your house can begin. So these are they are typically before you can get pre-qualified for the construction loan, you must undergo the pre-development. So this brings out your cost estimates, you know, gets us to know how much the ADU is going to cost, how much is going to go into pre-development, there are lots of stuffs which are listed under pre-development, but it's not every location or home that has to go through all those kind of procedures. So it is peculiar to where you live, based on your landscape, whether it's flat or it's slopes, all those will be taken care of by your general contractor doing their feasibility study. Can we move on to the next? Yeah. So for the Keys to Equity program, so our goals is to support wealth building for Black families in Auckland, create alternative housing solutions, allow long-term residents to age in place, and then create a scalable solution to the housing crisis most of the cities around America is facing right now. So these are the goals, right? So comparing the first lien, which is the cash out refi, which is offered by Self-Help, to the second lien, which they just designed, which is a home equity loan. So for the cash out refi, they are willing to lend, up to 100%, of the value, and can even go up to 120% after the building is appraised, after construction. And the debt to income is 48%. They are willing to use 75% of future income to qualify as qualified borrowers with their income, and it can take a term of 30, 20, 15 to 10 years. And the minimum credit score they are looking at is 540. And the higher your credit score, the better rate that you get. So the only difference between the two is the combined loan to value, which for the second lien, they go 90% and up to 100% of the appraisal when construction is done. And the loan terms. So for the second lien, they can go 20, 15 to 10 years. One good advantage is that when you looking at the current market, interest rates are high. So getting a first lien, a cash out refi would increase your housing payments. But getting a second lien, you retain your first mortgage, and then you get a second lien, which will be a subordinate to the first. And out of that would be only the estimated cost of build, which would get the prevailing interest rate. So your housing debt or housing payments will relatively go down using the second lien product. Can we go to the next slide?
Yep, and Charles, we had a question in the chat. So I think if someone asked, can you use multiple financing products to build your ADU? Can you stack the financing loans?
That would be a difficult one, because and it would primarily depend on your debt to income, because every lender will look at the risk involved, and your debt to income will prove to them how much risk tolerant you are. So they will be willing to lend to you according to their guidelines. And I know that for Self-Help's 48%, that is the best you can get on the market right now. Everybody is looking at 43 and 43 to 45. And even the CLTV most are looking at is 95 after construction, when it's appraised, 95% CLTV. So these ones are sort of tailor-made for the Keys to Equity program. Yeah.
And then we had a second question as well. I believe it was, can housing insurance and taxes be included in the home loan?
Yes, that will certainly be included after closing. And closing, Yes, that will certainly be, yeah, be included. Yeah, it would. So after construction, it will be appraised, and when it is appraised, the city will have the assessors, assess the tax liabilities, yeah. So how is loan to value calculated? So if you, well, when you elect to work with Self-Help Federal Credit Union, your loan will be fully underwritten by Self-Help, for your ability to repay, your willingness to repay, and adequacy of collateral. So what they've given us, as I spoke earlier on about, is the loan to value that they're looking at is up to 100% estimated value subject to completion, or 120% as is appraised value prior to closing or construction. So, and then the debt to income, as I mentioned earlier, is 48%, and they are willing to use 75% of the future rental income. If you are willing to rent it out, after completion, they're willing to use 75% of that monthly rental income as your income, to qualify for the loan. Right. So we have a couple of scenarios that we are going to walk through, and to give us an overview of how the debt to income is calculated, and so in scenario one, I would say it reads, Mr. Johnson owns his home in East Oakland. His gross income is $200,000 per year, paid bi-weekly, and the current outstanding mortgage is $400,000 with a property value of $700,000. So all these are assumptions, and we are assuming that he has a FICO of 680. So in the first part, which is on the left, that's before the ADU, calculating their income, since it's bi-weekly, we are going to divide the 200,000 by 26 weeks. By 26 weeks. And then, so to get the monthly gross, it's 26 weeks will give us the bi-weekly. And then we pick on that. So 200,000, I just want to make everybody understand the calculations. Yes, so that is going to give us 7,692.30, and we will look at their monthly obligations. So he has a car which is $350. He has a credit card which has a monthly payment of $100 on it, and a student's loan, which are mostly they take 1% of the student's loan as the monthly payment. So if you owing 200,000, they're going to take 2,000 as your monthly payments, unless you have a scheduled payment plan or something to prove that this is the amount you are paying X dollars in your student's loan payments. And then the current mortgage payments that they're making on the 400,000 is 1,853. So we are going to sum all the monthly payments up and then divide it by his monthly income. And per the right side of calculation, we get 39%, which is good. And after the ADU loan comes in, okay, so after the ADU loan comes in, his income is gonna, they are gonna add up the 75% of the future monthly income to the original, his original monthly income that he was earning, his personal monthly income that he was earning, which is 769,000 to 7,692 And then plus 7,692 plus 1,390. So what they use is the housing authorities figure, and for a studio. So it will depend. Probably maybe your lot can build 2-bedroom ADU. So they're going to use 70% of that amount. So for this amount, it sums up to $9,083.30. So, and then the proposed the new debts which are going to come on. So we used the price of the modules that we had, the 3 modules that we had. The bird model is a 440 square foot ADU, and it was budgeted then to have an estimated cost of 168,000 plus a pre-development cost of 25,200, which is pre-development is it is always 10 to 15%, but with what the general contractors have confirmed to us is usually within 12% and then to 15% of the estimated cost of build. So the total sum comes up to 500, and this includes the existing 400 mortgage that he has. This is a cash out refi. This is a cash out refi. So the monthly payments on that amount will be 4,099. And we are going to sum up all the other monthly payments that they'll be making. That's the car, the credit card, and the student loan. So that would come up to 5,299. So when we divide 5,299 by the monthly income, we get 58%, which is way above the threshold of the debt to income that Self-Help is looking for. So I think there's a question. Let me read it.
It says, do all income have to be 2 years old?
Yes, they all have to be 2 years old. It has to be continuous. That is what the underwriters look out for. So before they qualify it as income, it should be at least consistent for 2 years. Yeah. Can we move on to the next scenario? So the ideal debt to income ratio for Self-Help is 48%. 48%. So with other lenders, most of the lenders that we have in our pipeline that we've spoken to and we're working with are 43 and 45%. That is the limit that they give. So everybody doesn't have the same kind of scenarios. You know, some have jumbos, so their monthly payments are really high. So adding up the ADU debts, most of the time, from what I've observed, is that it takes them off, you know, that DTI limits. There are only a few people who are within the thresholds that the other lenders have stated out. So the second scenario is Miss Sally owns a home in West Oakland, has lived in the home for 25 years, a fixed income of $55,000 per year paid bi-weekly, and the current outstanding mortgage balance of $85,000 with a property value of $500,000. So looking at this, she's paid off most of her mortgage, so it is under $100,000, and she is making $55,000, which the monthly gross stands at $2,115.38. And she has a credit card, and she only has a credit card, and she's making a monthly payment on the $85,000 as $393.65. So summing up both of the monthly payments is $593.65 over the monthly income that she's making, which is $2,115.38. So that stands at 28% prior to adding up the ADU cost. And for the for the scenario on the right, we used the low module, which was estimated at 188,000, with a pre-development 15%, which is 28,200. So let me bring your mind to all these scenarios are cash out refis. They are all cash out refis. So yeah. And since it's a 1-bedroom, 75% of the housing authority rates will be 1,390 added to her original gross income of 2,115 38 cents, and she only has a credit card payment of $200. So now the proposed monthly mortgage monthly payments is gonna jump up to 1,394.90 cents. So summing that up and then dividing by her income, the DTI stands at 45%. So this is considerably within the 48% that they are looking for. Yes. So can we go to the next scenario? So Miss Sally owns a home in West Oakland. I think this is the same thing.
This is different. I think we just use the same name. Double check.
Yeah, it's the same. Yeah, it's the same. Yeah.
No, it's different. Yeah. There you go. It's just the same family.
Same family. Okay. Yeah. So yeah, same. Right. Yeah, I guess it's the same thing. So what this seeks to make us understand is yeah. So before this is giving us an idea of renting the ADU out. Yeah. So when you rent the ADU out, it's going to come with an income. You're going to get an income out of renting your ADUs out. So prior to Miss Sally owning her home, as per the second scenario, it's the same thing. She had, it wouldn't necessarily be an income, but her residual amount left after paying off her mortgage would be $720. But when she took on the new debt and constructed the ADU, the rent per the housing authorities is $1,854. I know it can go higher, you know, in Oakland based on your location, where you have your house and all that. It can go even up to like $3,500 or, you know, $2,500. So it would depend on your area. So looking at the that income coming in, her income is going to stand at $3,969 and then 38 cents. And she's only making a payment of $1,394.90 on the mortgage. So she's going to get an income, a remaining income of $2,574.48. Yeah, out of that. So this is the, we are trying to let you see when you rent it out and the income comes in, would that be sustainable, or how does that look like? This is what this scenario is trying to make us see. Can we go to the next one? Right, so for scenario 4, Mr. and Mrs. Green own their home in West Oakland. They have lived in the house for 25 years together. They have fixed income of $100,000 paid biweekly, and the current outstanding mortgage is $25,000 with a property value of 500,000. So it is like 50%. They own 50%. And Mr. and Mrs. Green built an ADU on their property for 188,000 and leveraged self-help second lien product. So this is a scenario depicting the second lien. So before building the ADU, they make 100,000. So their monthly income is 3,846.38. And then their monthly payments will only be on their housing, the mortgage, the current mortgage balance, which is 250,000. And the payments is with an interest rate of 3.75. We know that the interest rates are higher. So the payments is 1,158.90. So subtracting that with their income, they are going to get 2,687.48 as the remaining income. So after they built their ADU, this is a cash out refi. So they are going to retain their old mortgage payments on the 25. So that is going to be their first. So they're still going to be paying the same amount, which is 1,158.90. And then the second lien would be the ADU. I think we forgot to add the income that's going to come out of the ADU to it. The income which is going to be generated out of the ADU. So one bedroom is 1,000 per the housing authorities figures for Oakland is $1,895. So this second lien debt is going to be 1,219. This is based off on the current interest that is prevailing, which is 6.75% for 30 years. So that brings their total debts 1,158.90 plus 1,219. It brings their total debt to 2,377.90 cents. And for their income, we already know that they are earning 100,000, and the monthly payment, the monthly gross is $3,846.38. And we are now going to add the monthly rent, which is going to come in per the housing authority figures. I know it's going to go high, so we are just using the rough estimate from the housing authority. So which is $1,895. So their total income is going to stand at $5,741.38. And we are going to divide that by their monthly payments, which is the first mortgage and the second lien. 2,377.90. So their income, their retained income is going to stand at $3,363.48. Okay, can we move to the next slide? We have a couple of slides. So equity. So how do we calculate equity? To find out how much equity you have in your home, you subtract the amount you owe on all liens secured by your house from its appraised value. So your current property value, let's say you appraise it and it's 700,000, and you currently owe 250,000 on your mortgage, and probably you have a HELOC of, let's say, 50,000, making it 300,000. So the equity that you hold in your house will be 400,000. So we are going to divide, subtract the 300,000, which is 250 in mortgage and then 50 in home equity to the 700 property value. So the equity that you actually hold would be 400,000. And when it's expressed in percentage, that is the loan to value. Okay. So can we go to the next? So how does my income qualify? So we already understand your equity, which is your property value minus the mortgage balance or any other liens that you have on your property. So how is my debt to income calculated? So step one is you're going to add all your monthly bills, only consumer recorded debts on your credit report. Yes, so those are the only well, the underwriters also have means of checking if there are any other debts that you hold which are not reported on your credit report. They have means to also verify that as well. And then the second step is we are going to divide the total of your gross monthly income, that is income before taxes. So when you divide all your monthly bills, all the monthly payments, we divide it by your gross monthly income. That is how we get your debt to income. And there is an example. Mr. Johnson has a W-2's wage of 800,000 annually. His annual consumer debt is 10,800. So for his monthly car payment, these are I think, okay, it's annual. So we are now going to find the monthly. So the car payments, he has a balance of 4,800. So we are going to divide it by 12, meaning it is 400 monthly payments. He's going to be making 400 in monthly payments. And then the credit card debt is 6,000. So we are going to divide it by 12, which means 500 in monthly payments. And for the wages, there are so many dynamisms to calculating the W-2. If he's a weekly earner, it has different calculation. If it's a bi-weekly, it has different calculations. But for the example, let's assume it's bi-weekly. So the monthly wage for income, the monthly gross for Mr. Johnson is going to be 6,153. So to get the debt to income, we are going to add up the car payments and the credit card payments and then divide it by the monthly gross. And per this example, it's going to stand at 14.6%, which is in line with what the lenders are looking for. Yeah, can we go to the next slide? So pre-development loan pool. So we at IRNHS are excited to assist our clients, who are developing their ADUs with their pre-development costs. So we have a loan pool which we assist clients with if they do not have money upfront to cover up their pre-development, and that would go back into their loans, when their loan closes. So we are going to get refunded for that amount so that it remains in the pool to help other people also to get their ADUs built, to get their pre-developments done, to get the ADUs built. So once you're accepted into the program, you have to, and you have been approved by a lender for funding, we'll set aside that amount, which is 10 to 15%, depending on what comes out of the feasibility study done by the general contractors, and then IRNHS will fund that amount until the loan is closed, that we get that refund back. Can we go to the next slide? So how do you assess that fund? So you inform your housing counselor, which is me, that you need support for the pre-development. And then that would be evaluated because it's going to go back into your loan. We are going to go back and calculate your debt to income, to make sure that it meets the requirements during the soft review, and then we do have a form that an individual is going to fill out, and send it to the housing counselor so that we would have that assessment done and then consider you for the pre-development funds. Can we go to the next slide? So what goes into pre-development? So the pre-development funds covers some of the items listed. It is not all these stuff that that applies to everybody. There are some which might not apply to you. So one is the site visit, the property walkthrough, which includes photos of property, line and topographic surveys, site plans, evaluations, cross sections where needed, tree surveys, grading, creek protection permits, car green checklist, ADU checklist, property tax evidence, plan titles, scope of work. It has a whole lot. There's 26, title 28, energy documentation, site plan, demolition plan, floor plan, construction sections, elevations, foundation plans, framing plans, details and sections, structural, zoning review stamps, EB-MUD reports, and then the deed restriction reports. So these might apply to you where, where probably your property falls in. It is not automatic that all these 26 are going to apply to an individual. And we go to the next slide. So this is the acknowledged form that you're going to fill out and then send to the housing counselor if you are interested in the pre-development loan pool. And we go to the next slide.
So this is just, yeah, I'll hop on this. So this is just the resource list while we're actually at the end of the presentation. Charles, thank you so much. I'm going to unshare my screen in a second, but you all, this resource list will be shared out with you all after today. So you'll be able to click into these links, right? If you haven't already visited these sites. So let me just stop my screen share. This was recorded, right? And we will share this recording out with you all. Do you all have any questions for Charles or myself? Thank you, Charles. And thank you all for being engaged and asking questions. I don't think we missed anything in the chat. Right.
No, there's nothing in the chat.
Got it. As a reminder, we have office hours tomorrow, right? So if you want to go through some more scenarios, if you have questions about your own situation or just general questions about the program, definitely come tomorrow at noon. Is this only for properties within Oakland? Yeah, yes, at the moment, the program is only for properties in Oakland, but the information is universal, right? So constructing ADUs is similar everywhere, but so everything we talk about is very similar in other places, but when we say self-help or this program, it's only for Oakland homes, right? But you can get financial products to build ADUs in other cities and counties as well, these same products, except for the self-help products.
Right, we can furnish you with resources that we have, to assist you get financing and even general contractors as well. So yeah, we are open to sharing our referrals with you. Yeah, absolutely.
And who knows, we may have a program that we can refer you to in another city. So definitely come and talk to us about what you have going on. Thank you, Charles. Yes, I agree. Any other questions? So remember, you're going to get a link for office hours. Please come and ask your questions if you think of any. This was great. We appreciate you all. And please go to the keysequity.org website if you intend on filling out an interest form and have not already.